In an opinion piece in the Financial Times yesterday, WTO boss Mrs. Ngozi Okonjo-Iweala described an ongoing trade crisis, a stress test for global trade, but adding that while the WTO core still holds, members cannot see the status quo as an option. She advocates reform that preserves what works and courage to change what does not. This implies, as she writes, modernizing the rulebook, which mostly dates back to the early 1990s at a time when China was the underdog and Africa and most emerging economies perceived as providers of raw materials at the bottom of the value chain. The treasured consensus decision-making system now looks like a huge liability. A new WTO needs to be more plurilateral, she says, allowing for flexible coalitions in areas where members can be free or not free to join. There are many so-called middle powers such as Singapore, Switzerland, Australia, the UAE, New Zealand, Uruguay, and the UK who are actually benefiting, she says, and like what the WTO is doing. The view of South countries, some of them gathered in Tianjin this week, is that a world where the United States and its allies tend to speak for everybody else has passed. That is true. Ambassadors in Geneva identifying and working on reforms have first to project a different vision of a multipolar world where less developed populations must also be given a voice, where inequality in development is also seen as suboptimal, and everyone must have their fair share in the global trade pie. That is not so today. I must add that WTO is not unique in its need for adaptation. Other groups like the United Nations, the World Bank, International Monetary Fund are slowly finding themselves in a similar situation. The Second World War ended over 80 years ago, and the Bretton Woods institutions birthed after played their role more than well. There is, of course, a gap in the political will and cohesion required for ministers or leaders to bring, as Madam Iweala says, their heft to the task of reform. You almost need a different good crisis to precipitate the appetite needed for this type of reform, while one also agrees languishing in the status quo is recipe for natural extinction, and not just for the WTO, despite what is described as a strong core in these organizations. Hello, this is Global Business Insights, where we go deeper into the headlines to understand how the dynamic context affects the business landscape and what could be potential responses. Parent company Gem Diamonds said yesterday that Lesotho's biggest diamond mine, Letseng, has laid off 240 workers, a fifth of its workforce, as it battles persistently low gem prices due to weak demand and an uncertain global economic environment. Diamonds are vital to Lesotho's economy, with the sector contributing up to 10% of its GDP and providing employment for thousands in the country of just over 2 million people. Diamonds, which are now being industrially produced, are also Lesotho's major export commodity, along with textiles and clothing. Business sentiment in Africa's largest economy fell to the lowest level in a year as firms navigate the new era of U.S. tariffs. A South Africa Quarterly Business Confidence Index compiled by First Rand's Merchant Bank and Stellenbosch University's Bureau for Economic Research dropped 1 point to 39 in the 3 months through June. The report said front-loading, cancellations, and production holidays in the automotive sector all affected confidence in the period. Economic headwinds such as challenges with electricity supply and a tougher external sector have also weakened sentiment. Sentiment needs a boost to get higher investment levels to lift economic growth and employment rates in an economy that has remained stagnant for more than a decade, with unemployment rate now extremely high. According to the IMF, in a report earlier in the year, South Africa is well positioned to confront declining real per capita income and persistent unemployment, pervasive poverty, and one of the highest inequality rates in the world. This, it says, are due to structural rigidities and governance weaknesses which are being addressed. Reforms underway include in the electricity sector, allowing for more private sector participation in generation, including from renewable sources. Also, reforms encouraging private sector participation in freight, rail, and port operations are ongoing. The government is also streamlining digital communications regulations and water licensing procedures and digitalizing more government processes to enhance efficiency. The IMF analysis had suggested that reforms halving South Africa's business regulation, governance, and labor market gaps relative to peers could increase medium run output by 9% and further boost employment. It recommends much more aggressive cutting of excessive red tape and administrative requirements and ensuring that small and medium enterprises have fair access to markets. In addition, further efforts to fight corruption, professionalize public administration, and improve the governance of state-owned enterprises will build trust in public institutions and create a more stable and predictable business climate. Also, labor market reforms to help young people enter the labor force and make regulations for small and medium-sized enterprises more flexible. All these are all key to durably reducing the high unemployment rate, given the situation where 1 in 3 adults and 2 in 3 young people are out of work. It's not all bad news. South African bonds have, however, remained resilient amid concerns about the sustainability of fiscal debt burdens, this again amid low economic growth and sticky inflation. The trend of longer-dated yields on U.S. treasuries, UK gilts, German bonds, and debt instruments from France to Japan going to historic highs is evident. Meanwhile, South Africa bond yields have been relatively stable, thanks to what many have said is due to sound fiscal and monetary policy management. Higher bond yields could also make bonds of developing economies less attractive. Still, markets are increasingly sensitive to fiscal issues as more treasuries feel the pressure of the tighter environment. There is a common thread running through most major African economies in need of hyper-growth to restore the well-being of increasingly impatient citizens. More developed economies like Egypt are currently on IMF life support. South Africa needs more investment to revamp infrastructure and accelerate growth to reduce very high unemployment, while developing economies like Nigeria are pushing reforms, hoping to see transformational growth, while the epileptic power sector continues to hold back progress. And slowly abating double-digit inflation implies in the near future improvements look at best marginal. Fiscal strain and reduced appetite for aid or concessions from the West and a significant leap in investment in defense is starving less developed economies of funds. Corruption has also left the purse riddled with fiscal leaks, compelling a toxic dependence on expensive borrowing, either in domestic funds or bonds. For Africa, analysts say it has to be back to basics. There is no magic wand and no deliverer is coming from China, Brazil, or America or anywhere else. It has to be fiscal discipline, judicious use of capital, frugal governance, and enhancing productivity and efficiency, often implying privatization of underperforming or wasting assets, the many ventures that need to benefit from cost-competitive injection of private capital. Yesterday, we saw soft U.S. jobs data and the global bonds sell-off keeping investors on edge. This was also as the boost from a ruling allowing Google to continue lucrative payments to Apple pushed up the Nasdaq Composite by 0.98% and Alphabet also up around 0.68%, while Apple also gained 1.31%. Latest job openings, that's the measure of labor demand, dropped 176,000 to 7.181 million by the last day of July, also lower than expected. Private sector labor market growth in the U.S. slowed in August, according to the ADP report, which showed that private payrolls increased by just 54,000 in August. That's according to data published yesterday, also below the consensus forecast of 75,000 and a significant drop from the gain of 104,000 in July. Nella Richardson, ADP's chief economist, added that the year started with strong job growth, but that momentum has been whipsawed by uncertainty. But the S&P 500 still closed at a fresh record high as traders shook off weak employment data that was yesterday. Today we just got the Nonfarm Payrolls jobs report. The market wanted a Goldilocks jobs report figure that boosts rate cut chances while not causing a scare about a recession. U.S. non-farm payrolls was up by 22,000 in August compared to 75,000 expected and lower than 73,000 in July. The revisions by the Bureau also showed non-farm payrolls change in May and June combined was 258,000 lower than previously reported. The unemployment rate also edged up to 4.3%. Annual wage inflation change in hourly earnings declined to 3.7% from 3.9%. Again, good news for the Fed as the focus shifts to August CPI. That's inflation data coming out next week. Also, it has to be said that this was the smallest monthly increase since January 2022. The BLS the jobs gain in health care were offset by job cuts in the federal government, mining, quarrying, and oil and gas extraction. Manufacturing jobs also fell by 12,000 and is now lower by 78,000 over the year. U.S. futures rebounded after the data release, signaling delight that the data helps make a better case for Fed policymakers to lower interest rates by at least a quarter of a percentage point at their September 16-17 meeting. The debate may now be on how low and how frequent we're going to see the rate cuts. Lower cost of borrowing, of course, helps bottom line and thus sentiment. 3 rate cuts apparently now on the table. Some better news also came in as the US ISM Services PMI unexpectedly rose to 52.0 in August from 50.1, also exceeding forecasts. A Zambian court has sentenced former Foreign Minister Joseph Malangi to 4 years in prison with hard labor after being found guilty of corruption. Malangi, who served under former President Edgar Lungu between 2018 and 2021, was arrested in late 2021 and accused of using embezzled state funds to acquire high-value assets, including 2 Bell 420 helicopters. In the US, heads of the largest US tech companies have lined up to back an artificial intelligence initiative spearheaded by First Lady Melania Trump. Microsoft Chief Executive Satya Nadella and other CEOs, including OpenAI's Sam Altman, Google's Sundar Pichai, and Apple's Tim Cook, gathered at the White House as tech executives endorsed a plan to help America's children learn to use AI. At the dinner, Trump warned of fairly substantial tariffs on chips coming shortly, but investors in the US will be safe. Asia-Pacific markets closed mostly higher after President Trump signed an executive order formalizing a lower Japanese auto import tariff of 15%, down from 27.5%. The order also confirmed the agreement for $550 billion of Japanese investments in U.S. projects. U.S. markets opened higher on hopes that the jobs data just out will trigger a Fed rate cut, and the dollar is also weakening. Well, that's all we can take on this episode of Global Business Insights. This is Bode Oshosami. Enjoy the weekend. Thanks for watching.